Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 21st, 2015. In this video, I wanted to do an overview of the U.S. markets with a little bit different approach than I normally take. Typically, I'll take a look at the charts on the U.S. indices, various U.S. stock indices, and focus really on price, action, volume, support, resistance levels, trend lines, etc. And I will touch on the charts on the U.S. equity markets at the end of this video. But what I wanted to do is take a look at some different measures. Technical analysis doesn't only involve price and volume. There's other, it's pretty much the art of using, or art and science of using past market data to predict future results. And that's what we're doing here. So we're going to take a look at some different measures. All of these have been talked on in the site in the past, but I'll just kind of give us a overall outlook or picture of the market right now. Starting with the CPCI, this is the options index put call ratio. So these are measuring puts versus calls, how many puts, how many calls as a ratio are written on the indices, U.S. stock indices. And this one I posted on the site recently. What we're looking at here is an extreme, the red lines are the put call. We're using this on a daily basis. Yeah, so each one of these is the daily readings. We had an extreme back here right around the time the 2007 market top was in, just before the big Great Bear Market. And more recently, we had this spike here, followed by quite a few other spikes. So, any one spike in itself doesn't always signal correction as imminent. And, and I'll play devil's advocate here on this one. If I go back, we're looking at a 9-year history here. If we go back 20 years or more, there was a time where we saw some of these, quite a few of these that didn't signal correction. But with that being said, again, these aren't standalone buy-sell signals, but they are an indication of sentiment. That's all simply a put-call ratio does. It measures market sentiment in one of the purest forms. They have all those other sentiment polls. Obviously, I'm sure there's quite a degree of a variance, I should say, of accuracy. But this is where people, they're putting their money where their mouth is. And obviously, some people are hedging, some aren't. Some are just making pure play shorts or long calls. But the bottom line is, when you have a tremendous drop in the ratio like this, it does speak that there's a lot of complacency. In other words, a lot more call buyers than put buyers. So again, just wanted to point that out. We've had that large drop. Here's another big drop here, and that was followed by a correction. So some of these have been followed by corrections. This drop was like nothing we haven't seen in years. If not, I don't think we've ever hit that low on this measure. And again, we've had a few very low readings since then. So this speaks, to, as I said, to complacency, lack of fear in the market. Okay, and this next chart is just the CPC, which is the total put to call ratio. So that includes, individual stocks as well as indices. So we're looking at, this one shows a little bit clearer picture. What I've added here is this red line at the very bottom, this dotted red line. The blue arrows mark every time that the put-call ratio has dropped to that level, which is a little bit below, looks like a little below 60, so 50-something-ish. And as this chart shows, it's very clear. We've had only four, counting these two, we've had two consecutive tags. And, with complacency staying low, the market staying high, not having experienced a correction, these I count as really one. They came in very relatively close proximity, so that's just a double tap there of an extreme, complacency measure. And as we see here in the boxes, what followed that first tag back in late 07 at the market top was a 55% drop. This next tag here led to a 17% drop and then a 21% drop in the market. So far, we've seen virtually nothing. The market continues to hang in there. It's not going any higher. If you'll notice, I know there's a lot of dejected bears out there, but there should be as many dejected bulls. I'll talk on that in a second. The markets are ranging from, the indices I'm looking at virtually flat to, up 2.5 to no more than 4% 4.5% depending on which index you look at, small, medium, large caps. I'm talking year to date, folks. So, it's been pretty much a go nowhere market all year. We've had some ups and downs within there, but at the end of the day, we're barely into positive territory. Excuse me. So, just wanted to point this one out. Okay, so that was looking at the market from a sentiment perspective. Now let's take a look at market breadth. In other words, what's under the hood. This chart shows the SPX A200R, which is the percentage of stocks trading above their 200-day moving average. We're looking at a weekly chart, and this goes back 11 years we're looking at. At the top of the chart, we have the S&P 500 plotted in orange, and at the bottom there's the percentage of stocks trading above or below their 200-day moving average. So the scaling over here, as you can see, you're never going to have 100% of the stocks, so the scale stops at 95. Well, I should say that the very upper end of it is not shown there would be 100%. And 0 at the bottom. So right now we have about 58%, a little over half of the stocks trading above their 200-day moving average, which was really about where we were when the market topped back in 2007. So, give or take, you're usually going to be within that 50% range unless we have some extreme moves in the market, such as, during the financial meltdown and then the strong rebound following that. But what I've pointed out in the past on this chart is simply the divergences. What we're looking at here, the white vertical lines mark every correction that we've had, every decent correction that was followed by these negative divergences. By negative divergence, I mean prices. In other words, the S&P 500 making higher highs, as these white lines show up here, against the percent of stocks trading above or below their 200-day average declining. So we have the negative divergence here. As you can see, this was actually double divergent top. In other words, we had this peak here. The market continued higher from this point while we had another steeper decline, and then a correction set in. And again, this is a pretty wide range here, going from 700 all the way to almost 2200 on the S&P 500. So each of these are significant corrections. I mean, of course, we have the great bear market and the following bull market on this, so it kind of makes these smaller corrections look like they weren't much, but they were decent corrections within the market. So as you can see, every instance I struggled. I don't think I could find a single instance where we had negative divergence that was not followed by a correction. And so now where are we today? Well, we have this what I call double divergence. Again, we had the percent of stocks above their 200-day moving average declining against the market rising. We did have a correction there, so I did add this white line, but this looks to be a continuation. That correction was relatively small. The market has continued to move higher while this ratio has dropped. And more importantly, look at just the past few weeks. I don't have a divergence line drawn here, but we've had a really sharp drop-off. And that is telling us that fewer and fewer stocks are doing the heavy lifting in this market. A good example is Friday. In fact, I had put this video together. I spent over 2 hours going over the charts, recording this video, had it ready when I was uploading it to YouTube. As soon as I completed the video, I found out the sound wasn't recorded. I had some things to do Friday afternoon. I had to leave. I didn't have time to re-record the video. But this, I wanted to point out, today the market looks like it's trading down a little bit. I actually did this video intentionally on Friday because we had an extremely strong day in the NASDAQ. Yet, at the time I was doing that video, the equal-weighted NASDAQ, which is the NDXE, depending on which charting program you're using, the equal-weighted NASDAQ was actually negative for the day. And the reason for that is one single stock, and as most of you know, if anybody was around on Friday, was Google. Google, unbeknownst to some people, it's actually the second largest weighting in the NASDAQ 100 index. Because what happens is when Google split, you have the two share classes. They both are represented as different stakes. Let me try to explain that to you here. So there's Google L, which I think are the Class A shares, and the symbol GOOG. if you look here, 4.22% and 3.71. These are the top 10 holdings in the Nasdaq 100, and so if you add up those two, you get what is that? Better, well over 7%. Actually takes you right about to almost 8%. So that puts Google, since they do count both share classes in there, that is bigger than Microsoft. And so Google's the second largest holding behind Apple. And as I said, that speaks, the reason I was bringing this up, and I was trying to cover it that day while the market was up strong, or at least I should say just the NASDAQ. At the same time, the S&P 500 equal weighted index, I believe, was negative, and the regular S&P was flat as I was doing the video, or just slightly up. Google also has, I believe, a decent weighting in the S&P. But the point being that had you backed out Google that day, just not even included the stock, we would have been the NASDAQ, and the NASDAQ 100 would have been down for the day. So it shows, and we saw this the other day too. Netflix had a really big day, and although not one of the top holdings, that definitely, it's up there. It's a good sized stock, and it definitely had an impact on the market. So that's what we're seeing here, and is that a lot of these big name stocks are carrying the market, and when you go down, you dig down into the bottom 100, and especially you get into the S&P 500. I think that's more important. Again, the Nasdaq 100, as well watched and traded as the Qs are, is not it's not a completely representative index of the U.S. economy. First of all, it's only 100 stocks, and it doesn't include financials. It's a very tech heavy. You look at the top holdings here, you're seeing just tech and biotech, and that's mostly, or the bulk of what the NASDAQ 100 is, a lot of tech stocks there. So, okay, one more indicator to look at here, or I should say a sign that all is not well under the hood. This is the the Federal Reserve Economic, or I believe Federal Reserve Economic Data, something like that. So this sign is, this information, this graph does come from the Federal Reserve, and we're looking at two things on this chart. The red line is the S&P 500, and here's the scaling over here on the left. And then we have the BOA Merrill Lynch U.S. High Yield Master 2 Option Adjusted Spread. Sounds like a mouthful. Basically, these option adjusted spreads are on high yield instruments. Tell us a spread between safe money, i.e. treasuries, and junk bonds. High yield bonds or junk bonds, companies with a triple C or lower credit rating. So what we can look at. Okay, so what stands out to me on this chart are two things. Not as important, the level. We can look at the level here on the credit spreads, and they are about where they were when the financial crisis kicked off. When the market topped in '07, we are about the same level. But what really stands out to me is the trend, or I should say a disconnect between the relationship. There is a very, very strong inverse correlation between the stock market or stock prices, how the market's doing, and option adjusted spreads. You can look at this chart here. You can go to the site yourself, follow these little the crosshairs, the lines, and what you'll notice is when the market is dropping, as the S&P did during the bear market, credit spreads are going up. And this comes down to within days, weeks. You can see here, look at the nearly perfect inverse correlation. One goes up, the other comes down. There is virtually no disconnect between that relationship. Although we're going back as far as I can on this chart. The Federal Reserve, unfortunately, on this chart only plots the S&P 500 back to 2005. So, I wish I could look back 10, 20, or well, I should say 20, 30 years or more. But this is all we have to work with. Now, what we can see here is a sharp disconnect. At this point here, where the market was making, just before the market top in October of 2007, we had another previous high that was a little bit lower, and from that point there was a correction. That started sending credit yields up, as it should during that initial correction. However, what happened at that point, the market went on to push to make new highs. What we had is a complete and utter lack of fear. Now, this may not look like much. Let me zoom this in and take a look at this. Okay, let's see here. Okay, so what I'm doing is, oops, did something wrong here. Bear with me. Got to get back to where we were. Okay, that shaded line indicates recession. Excuse me, recession in the economy. But you can see, as always, stock market tops long before they tell us we're in a recession. In fact, they didn't even tell us we were in a recession here. That comes after the fact, as it always does. So, the next recession, don't expect bells going off in the financial media to say that we've entered a recession. You'll hear about it well after the market has come down probably 20% or more, if not 30 more or more. Anyways, I digress. What I wanted to point out here is the relationship here. Okay, here's what I was trying to do. You can see this big move, and credit spreads were, if you look at the right-hand scaling, about 2.4% at the lows here, and jumped sharply. I mean, we were at this point here all the way up to 4.8, nearly, well, right at a double, I should say. And even then, they abated somewhat at this last thrust up, but not nearly. They were well above where they were before. So not quite a double, close to it. And again, you can look at this chart on your own. I've done this. This is the only other time in the history of this chart, the data that they have here, that we've seen anything remotely close to that is over the last, looks like about the last year or so. I've pointed this out before. We've seen this very sharp increase. You know, we had the credit spreads down here around roughly 3.3%, going on to make a near double recently. Market continues to push to new highs. We've had hardly a correction. We had a little bit of a pull down here. And of course, that gave us a spike in the credit yields. But look where we are, just in the last about the same amount of time it took for the credit spreads to ramp up before the market top in '07. We've had a near doubling, and while the stocks go on to make new highs, the VIX is, right back now or right off the low end of its range. So this to me says a lot. It says that there is risk being priced into this market by the smart money. You and I aren't trading credit spreads. These are the big Wall Street firms. This just reeks that something isn't right under the hood. And again, the one downside I'd have to this is I wish I had a longer sampling period. But if I'm not mistaken, a lot of these instruments are relatively new. And so even though the Fed keeps data going back to all the way to looks like 97 or so, maybe even before that, they only have the S&P going back this far, but you can see what's happened there. So again, I just want to point out that disconnect as a caution sign that all might not be well under the hood. Okay, to wrap this video up, let's just take a couple minutes to look at the U.S. markets. This is the S&P 500. We're looking at a couple-year chart. Let me zoom in here. So you can see here the S&P 500 is really coming close to struggling with the highs that it put in back in on May 20th. That looks like the high so far in the S&P. We hit a high of 2134.71. Yesterday we got as high as 2132.82, so not quite there. So technically, by the book, the S&P topped back in May 20th. Now, we're right off those highs. I'm not declaring victory as, I've been bearish on this market, unfortunately, longer than I should have been. But with that being said, the market is going almost nowhere and hasn't for pretty much the entire year. Now, let's take a look. This is the S&P 500. Now, let's take a look at the equal-weighted S&P 500, which is well off its highs. So where the equal-weighted peaked back here, also on the 20th, we are, let's zoom in a little more here. Let's see, we are at this point right now today, looks to be about 2.5% below where we were at the peak. So far the equal weighted. And again, if we just looked at the regular S&P 500, we were almost at that high. What this tells me, if you take out the overweighting of the top components in the S&P 500 and just give everything an equal weight, all 400 and something. There's not 500 stocks. It's 470 or something. I don't know the current number, but they usually have a little bit under 500. And give each one of those companies an equal weighting. You can see that we've been losing steam. We topped out a couple months ago, and it's too early to declare victory if if you're a bear trying to short the market. And again, you've probably been trading the SPY directly anyway, so you're right at where you were. They do have some tracking ETFs for these equal weighted funds. But let's take a look at the NDX. Just trying to make a point here. So there's the NDX. Looks like it's on fire here. Look at that rip. A lot of that, like I said, Netflix, Google, those were earnings-induced pops. They weren't really technical events. Google did break out of a pattern that it had, but it gapped out of it so hard it wasn't really anything anybody could have chased. And again, the big move was attributed. A lot of the move recently was attributed to Google. I knew at least Friday's move was. So we look at the NDX, and that looks strong. Now let's just look at the equal-weighted NDX, and this tells a completely different story. As you just saw, the NDX ripping to new highs. The index E, if you put an equal weighting on all 100 components, the market topped back on June 22nd, and so far is yet to take out those highs. So, again, whether you're a bull or a bear, we look at the beginning of the year. Let's try to find January. There it is. So here we are from the end of the year, December 31st, to where we are today. And the equal weighted, we're up about 5%, and I think it's considerably lower. I already did the math on the S&P, was I think only about 2.5% or so. Okay, I'm going to wrap up with this chart. Talked about one of the better trend indicators out there. Is very simple and effective, and that's using a 20-day and 50-day EMA, or exponential moving average pair, on the S&P 500. So what you're looking at here, the bottom part of the chart I know is truncated. I'll scroll down to that in a second, and you can see at the very top. This is just a history. The red and the blue lines are the 20 and 50-day exponential moving average, with the S&P 500 behind there. Very subtle. I have a very light gray marking, but what I do, I have the S&P 500 below. So let me just get away from here. The lines, as you can see, before I move off this upper chart, anytime we had a crossover, a death cross, which is a cross of the 20 below the 50-day, that's marked in the red. And when we have a golden cross, which is a bullish cross with the 20 moving back above the 50-day, that's the green vertical lines. And these carry all the way down through the chart. Now what I've done, this is a little easier, a more simple way to view this. I created a histogram to show those crosses visually, because it's very hard. We're packing in, this is a 15-year time period. I would go longer, but it would make this chart almost impossible to see. So either way, we're looking at a 15-year history. This is the S&P 500 below in black. And again, these vertical lines, they carry all the way up, and they just show each and every bullish or bearish crossover that moving average pair. Now, as I often say, there's no one perfect indicator out there. This just helps you identify that intermediate term trend. And although there are quite a few whipsaws in here, if you look at when you see a green and a red line close to one another, what that would have done is pretty much got you in about flat, maybe a slight loss, maybe a slight gain. But what I want to point out here is, let's see if I can add an arrow to the screen. Give me 1 second. Okay, so you can study this chart. I'll try to put up a static version. I've covered this quite a bit on the site. My point here is and I mean all of the big moves. If you look at here, it got you. I was trying to get the beginning of that red line. Let's do that a little bit better. So there's your, 1 second. Okay, here's your sell signal there. And yes, that's when the buy signal came. So if you were short, you would have covered your shorts. For those of you that don't like to short the market and you're a long trader, at least you would have got out at that point and jumped back in there. Now keep in mind, I always use this in conjunction with the technicals. So I can almost assure you back here, this would have probably been a divergent bottom, maybe a market coming down to support. In other words, I've been pretty good at getting out before these these pairs cross over, and sometimes getting in the market short before it gives the bearish signal. But what they do is they help confirm the trend. And again, there are some whipsaws. This is a very long scale. Keep in mind we're talking 15-year price history. So here, look at your next sell signal. Kept you short, kept you out of this big drop there. You can see these drops. Here's where it got you in, again, short. Sorry, missed that. So you get the point. Get you in long. You would have caught that entire long move. Here's another decent long move. There's a very nice long move. And this is, these are multiple months right here. That looked like, nearly 6 months in. Here's the bear market in 2008, 2009. So they told you to get out here. The moving average pair did. It told you to get short again there or get out of the market, and you would have missed almost the bulk of the bear market. Did it get you in at the very bottom? No. But did it get you in close to the bottom? Absolutely. It would have got you there. It got you long there. That's a tremendous move there. Would have got you long over here. So you get the point that even if you had taken this signal religiously on every crossover, you would have had, over the years, quite a few whipsaws, but at the end of the day, you would have by far outperformed the market. You would have been in every major thrust up in the market, as you can see here. And as I pointed out, we recently had a bearish crossover, death cross on the S&P 500. Now, I do need to add that I haven't put in here, we just recently, you can't even make out on this chart, just yesterday, I believe, we had a whipsaw. We went back to a buy signal. The 20 crossed back above the 50 on the S&P. However, it has not even come close to crossing back over on the equal-weighted S&P. I believe on the equal-weighted NASDAQ, we're still on the sell signal. Mid-caps still on a sell signal. The Russell has yet to trigger. In other words, it hasn't had a death cross recently, but it's not too far from it. So, again, if you're looking at equal-weighted indices, they're still on the sell signals. But in the purest sense, this you should use this. You can't always second guess and say, well, okay, this time around I'm going to do this. If you want to trade the signal pure, then right now it's on a buy signal. So with all some of these other indices and the equal weighted indices not being on the buy signal, I wouldn't act on that. I wouldn't go aggressively long at this point. In fact, I just made a case how the market's deteriorating. So I just wanted to point that out. And sometimes we get these whipsaws where the signal, the 20 will cross over the 50 for just a couple days and go back down. But what we need to see, we're still waiting for some trend line breaks on the market for a real sell signal. This is the S&P 500 weekly chart. Now, this chart, as well as all the U.S. index charts, have been updated. So you can check out these charts on the site under the live charts page, and then you can zoom in. What's hard to see here in the video is, before we even got here, we had this rising wedge, and I had added this alternative. I called it an alternative uptrend line because there's quite a few reaction points down here. I'm talking about the black dashed line. And that was my next downside target. We did hit that. We hit that, kissed it perfectly. If we zoomed in, let's try that here. Okay, here's that chart zoomed into a 5-year period. You can see that trend line, quite a few reactions, caught that one. And so what we did is we hammered off of it, and this has been the ensuing bounce. So as I said, the S&P, although close to its highs, is still yet to take out the previous highs. We had this large bullish rising wedge pattern, what I called the primary uptrend line, which is now broken. We had the secondary uptrend line, which acted as support. And we've bounced now this is really week 2, although we're not much higher than we were last week. So again, the divergences indicate that a trend reversal is likely, and I still think that'll be the case in the coming weeks to months here. Okay, this has been Randy Finney with Right Side of the Chart. I hope you